Welcome everyone to episode 190 of the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And at Peak Wealth Management, we believe by providing education and guidance, we can help you retire with peak confidence. And Jim, today we're talking about deficits, right? The U.S. Treasury downgrade by Fitch last week. Naturally, this is a big news item for the market. It didn't move the markets very much.
Right.
Yields are up a little bit, which is actually what you'd expect, right, with a downgrade. But it wasn't anything dramatic.
Yeah, when it happened, man, when was the last time they did that? It was
2011.
I was going to say, it's been a while now. 2011, the market was shook a little bit more, right?
Oh,
It kind
big
of
time.
panicked about that news that the U.S. could be downgraded. Their credit rating could be downgraded, so it was a big deal.
Yeah, it was a huge reaction in 2011, but not necessarily as you'd expect.
Right.
Because when something gets downgraded, typically you sell
Right.
that particular
That asset,
issue.
yeah.
But what happened in 11 was everyone sold stocks and bought treasuries.
Yeah.
That was ironic. Rates went down,
Right.
even though the credit quality was less. But let's talk about the rating agencies for just 1 minute, because these are the guys who were rating all of the mortgage-backed securities in 2007, 2008 as AAA. And as we know, they were worthless, right?
Yeah.
So they were rated AAA, and that was a huge problem for the market. And basically, they lost a lot of credibility as a result, all of the ratings agencies.
Right. They're the ones that should have saw that it wasn't AAA debt anymore.
Right. And so now they come in and say that the U.S. is no longer AAA, while many other countries still are. And there's a little bit of muted reaction for a few reasons. But I think also, when we looked at last week, the markets were down a little bit, nothing out of the ordinary. But we did have a big run up in June and July. So it's kind of a natural excuse.
That's what I was thinking, yeah. Opportunity to take some profits.
Yeah. And rates, like we said, have moved up a little bit, but they're not breaking out into new highs. It's kind of like going to the top of the range from what we saw last year.
Right.
And earlier this year, actually, when the 2-year got up to like 4.2%, that's when the West Coast banks started falling, right?
Yeah.
But we're not seeing any news about that this time. So perhaps those were isolated events. But with rates as high as they are, okay, the Fed is pushing the brakes. And so, there might be other things that are breaking under the surface that we just don't know about yet. But I want to quote Fitch here, okay? They say, there's no imminent signs of Congress having political will to address the entitlement programs or the revenue that funds them and the rest of the government. So they come out and say specifically the entitlement programs. So Social Security, Medicare, Medicaid, okay? And we've talked about this at length as it relates to Social Security, where the trust fund will be empty in the next 10 years. And by the way, there is no trust fund. Okay, so let's keep that in mind. So it's really just, robbing Peter to pay Paul. And then on Medicare as well, there's, huge deficit funding needed for Medicare. So they come right in with the entitlement, and then they talk about revenue. Okay, well, guess what? The revenue for the government is flat year over year, while spending is up double digits. Okay, that doesn't work. The interest on the deficit on the debt is now 25% higher than it was last year because it's much bigger and because rates are up.
Yeah, rates are up.
Okay, so how can we raise revenue? Well, in 25, the Trump tax cuts will expire. Fitch, though, writes that they expect them to be extended. We haven't heard much about this, and certainly it's a long ways away, so we don't know exactly what will happen. But if the tax cuts roll off, well, then revenue comes up naturally because your 22% becomes 25 and so on. The 12% becomes 15 and so on. But that's a revenue opportunity. But where's the expense cutting opportunity?
Yeah, that's one thing we just never hear about, is it?
Even if there is a strict approach to expenses in the next budget in Congress, they're only controlling like 25% of the budget is really discretionary. The rest of it's already spent on interest, Social Security, Medicare, Medicaid, right? So there's very limited opportunity. You know what I mean? And here's the thing that really kills me is that, the economy has recovered out of the COVID slump. Would you agree?
Yeah, I would say so.
Would
Employment is still high. People are still looking for, more workers, money in the pocket for the most part,
Yeah.
the consumer. So yeah, I would say so.
If the government, can't balance the budget when things are good, what are they going to do when things are bad? Okay, when the next crisis comes along, what's going to happen? They're going to print more money, and the Fed will, do what they've been doing by absorbing the printing press, and it's just a bad situation. So I understand that Fitch downgrades, but are they downgrading other sovereign nations? I don't know. But the bottom line is, like, everyone knows this is a problem, but this is just a way to kind of shine the light on it and say, hey, what are we going to do about this? And right now, our leadership at every level is not addressing it, and it's a shame.
Yeah, I feel like, ever since COVID, everything's been very short-sighted. How can we put a Band-Aid on this? How can we put a Band-Aid on that? Let's just try to fix it real quick. And nobody's looking long-term enough to get out of the issues that we've created.
It's irresponsible.
Yeah, it's a shame.
It's very upsetting. When I get going on it, I start to get angry.
Yeah.
Basically, we go back to '99. We have a surplus, and that's what I was saying a second ago. The '90s were great for the economy. We went to a surplus under Bill Clinton, and as soon as the surplus was there in 2000, George W. sent out surplus checks to everybody. I don't know if I didn't get one. But I didn't know who to call.
Yeah.
and then in 2001, right, 9/11, and then now all of a sudden we're in recession after the bubble in 9/11, so there's more deficit spending, and then we're in Iraq and Afghanistan for like 20 years.
Right.
So those are huge trillions of dollars, right? And then in 2008, the bailouts and the deep recession. And so basically, those are the last 20 years where we go from a great spot fiscally to a terrible spot fiscally.
Yeah, with apparently no motivation to fix it.
Yeah, the only motivation really was after the downgrade in 2011 and the debt ceiling. The Tea Party arm of Congress was really battling to get spending under control. And guess what? That was when we had 10 trillion of debt, and now we have 3 times that much. Wow. And we're continuing to print. And this year, the deficit should be about 1.7 trillion.
Additional, yeah.
Yeah. So that's all I got for you on the deficits and the downgrade. Make sure that you're checking us out on YouTube, and please like the video. Please subscribe. It really helps us out a lot. And if you'd like to learn more about us and Peak Wealth Management, you can schedule your second opinion meeting at peakwm.com.